We're back. We have Darren Camus from IPOR. He's the CEO and also co-founder. Very interesting protocol, doing some really interesting work, bringing the so-called real world into our blockchain world. Darren, welcome. It's good to have you, sir. Yeah, definitely an OG, been around for at least 100 years, was there when... Tell us a bit about yourself, sir. I know that you've been around since pretty much day one, and it just doesn't end for you. You seem to be addicted to what it is that you do, and it's really cool to have you. Thanks for coming.
Yeah, thanks. So yeah, I mean, addiction and passion and conviction, maybe all of these things combined. So I started in crypto actually right after there was one of the first big run-ups from $3 to $30 and back down to 2.5. I joined one of the first exchanges in the world that was TradeHill, and we used to be number 2 to Mt. Gox back in the day, and been working in the industry ever since. So this is actually year 12. So I guess they say you count crypto years like dog years. So maybe you'll. I don't know what to expect, but I mean it's really about conviction in the space. It's an alternative, right? This technology was birthed kind of out of the financial crisis as that really as an alternative system. And so this kind of mission has driven me to do like a bunch of different things along the industry, and actually, kind of all roads have led to IPOR, and I consider this, kind of the legacy piece of my career. So.
Have you ever felt that way about any of the projects or any of the things that you've done along the way, or is this kind of like, this is it, like this is the one that do you genuinely feel that way about it?
Well, I mean, for sure. So, I was working on the exchange side. We'd done a brokerage. In 2014, we were looking at very kind of early zero knowledge proofs for audit protocols. So this is something that we're still dealing with today. How do you prove an exchange's solvency on chain? We're using like really, let's say, a really kind of primitive approach that has, evolved much since then. I did a cross-border payments company that led me to actually live in mainland China, and then I was one of the early advisors to Cardano. I mean, a lot of things that are very maybe also kind of too early. So this is the thing about innovation, opportunity, and timing, right? So if you do a lot of things, if you do the right things too early, you miss it if you do it too late. So the question is, what's the right timing? But in a lot of those, let's say, since about 2016, I've been out of the founder seat. So with IPOR back in the founder seat, really happy about that, and taking also all the experience over this time, a long-term view to the markets, and that's really what we have at IPOR. We consider it this kind of base instrument that will hopefully be this base layer of the DeFi credit markets. Dimitri and I were looking at this and thinking, okay, what kind of piece is missing from the markets right now that won't be a fruit farm, that won't be, let's say, the next hype cycle, that's actually has the potential to be this kind of stabilizing factor under DeFi, 2 years, 5 years, 10 years down the road. That actually has a net positive, right? So, for example, if we stabilize this kind of this rate dynamic in the credit markets, it's actually a catalyst to bring institutional funds into the fixed income space, and that has a boon for all assets. So this is why we think that the protocol not only enables kind of this large scale capital to flow into DeFi, but that also has positive effects for all the other crypto assets. So it's kind of a rising tide lifts all ships kind of dynamic.
So I mean, I have to ask the basic question. I mean, what is IPOR?
That's a great question. All right.
Like, what is it? What are you actually trying to do here? Like, problem, solution, or isn't there really a problem? It's just merely a solution into the DeFi space. What is it?
Okay, problem, solution. You don't have this stabilizing layer under the DeFi credit markets. You have a very simple construction. And let's say the most robust is this over collateralized credit markets. You can think Aave, Compound, anything where you put this collateral, you over collateralize, which we can maybe term as risk-free, or the closest proxy we have to risk-free in DeFi credit markets. And then this credit market dynamic where you have a borrower who is paying the lender, and they have this interest rate that they're paying. So that's a base construction. What the issue is that we don't have any semblance of a yield curve. And what that is, you know, if you're looking at treasuries, you know, you have a treasury rate for 1 year, you know, 5 years, 10 years down the road, you have short-term treasury rates, and you know, actually at these different kind of tenors, how much you can expect as a rate of return. And sometimes you have this shape that inverts and you have different trading opportunities there. But in DeFi credit, we don't know what the rate will be tomorrow. And if we don't know what the rate will be tomorrow, it actually, you know, you can't attract you know, large scale capital that way because it's too immature.
Yeah.
And so this lack of a term structure, this lack of a yield curve is a problem, but that problem we see as an opportunity. So maybe in simpler terms, we take two constructs from traditional finance and the credit markets and apply them to DeFi. One is a benchmark rate. The benchmark rate is just what's the cost of capital in DeFi. So what's the cost to borrow USDC? What's the cost to borrow USDT? Or what's the cost to borrow DAI? And we chose those at the beginning because they're the most borrowed instruments. And in the future, decentralized governance can choose to spin up an index for maybe another stablecoin or another crypto asset. You do that, and right now we have a spot rate for those, and that's actually sourced smart contract to smart contract. And then we'll start bootstrapping kind of this yield curve. We'll start putting out, you know, a 1 month rate. So you can know that you can expect roughly this rate of return on your USDC for 1 month, 2 months, 3 months. You have to build 3 months to get 6 months. So the further out that we can extrapolate this yield curve in DeFi, the more stability that you can have. So the more that you'll have people that are locking up longer term deposits because they can guarantee this rate of return. Now, the other part of that is the interest rate derivatives. So the interest rate derivatives, like a derivative instrument, it's built to mimic one thing, right? And in this case, it would be the interest rates in DeFi. So you can essentially do two things. You can go long or short versus the rates because you have some exposure. As a lender, you don't want the rate to decrease because that means your future income is hurt. As a borrower, you don't want the rate to increase. And these are typically, you know, opposite sides of the spectrum. So with the interest rate derivatives, you can effectively hedge your exposure, and that allows you to have this predictability, you know, over longer durations. So we have an instrument right now that's a 28-day cancelable swap. I mean, that's 4 weeks, that's 1 month. Then we'll extend it to 2 months, 3 months, 6 months, you know, and hopefully get out to you know, kind of these 1 year instruments, and that makes DeFi much more usable for people rather than, you know, only degens that don't care about the cost of capital over a short time. And this will bring more market maturity. This is the hope.
So I mean, this is all very pertinent to what's instrumental key to, you know, the flow of capital and obviously liquidity coming into the space, because that's essentially what it is. What you're doing is that you want to create an environment for predictability, particularly around these credit rates. How do you think we arrive at that point in light of the fact that there is still a lot of kind of like uncertainty around regulation, around kind of like how do we maneuver in the space? Because you clearly are solving an issue here. It's very evident. And one of the questions I want to ask you afterwards is like, how do you like kind of like play the game per se? And I know that you mentioned one of them, you know, in terms of hedging and the rest of it. But like, first of all, how do you think, you know, it's a little bit separate to IPOR, but it goes hand in hand. And I have to ask you the question, because you've been around for as long as you have, how do we overcome kind of like this murkiness around regulation? Where do you see kind of like a little bit of a kind of soothsayer position? I mean, where do you see us going from here, you know, in the next, say, 2 to 3 years, for example?
Murkiness around regulation has been the only constant in crypto. That and the inability to get a banking account, right? This has been an issue from the very beginning, right? But
Yes.
if you pay attention to this murkiness and you're waiting for clarity, then you'll never do anything, right? And this is the dynamic, and I hope this is kind of changing. And it's actually educating people around these different narratives. So people see this, what they call Ethereum, the dark forest. They see crypto as all these crazy people speculating on monkey pictures, right? Some of it's that, but you have a lot of these things that are extremely useful, right? So
Yeah.
I mean, this DeFi credit market it's really innovative, right? It's taking a lot of different constructs that you can get from traditional finance. It's adapting them. You have all kinds of new DeFi primitives that are really neat. And actually, let me focus on one, and we can compare and contrast TradFi to DeFi, right? So IPOR is called Inter-Protocol Overblock Rate, and why it's called that, okay. So if you look at it from a crypto native perspective, it's easily memeable, and people say IPOR, oh, you poor bro, or some people have changed that and say, I poor equals I rich, like this is
Yes.
these are all the easy memes, right? But why we chose this name is because it has a hat tip to the LIBOR, right? So this is a traditional benchmark rate, and it's very purposeful. So I can live with the memes as long as you get the utility, right? And what that utility is that the institutional capital is it's the largest capital pool in so you have people
Huge.
that are looking at IPOR and they're like, oh, it's like LIBOR for DeFi. So
Yes.
what was the LIBOR? So the LIBOR still exists, kind of. It's being unwound. Its death keeps getting pushed out. But the LIBOR is a benchmark rate, and benchmark rate, like the IPOR, is what's the cost of capital? What's the cost of borrowing $1 at different tenors between banks, right? London Interbank Offered Rate. And all it is a rate survey. So they go to a number of banks. They say, okay, so how much would you charge to borrow this currency for this time frame? They report it. That the high value and the low value are discarded. The rest is volume weighted, and that's printed once a day. I think 11 a.m. BST, and that becomes a single benchmark interest rate that becomes the basis of hundreds of trillions of dollars of deals, of derivatives, of different credit instruments. So if you think that the IPOR and the IPOR interest rate derivatives, they may be this invisible part of DeFi infrastructure that everyone deals with, but no one knows it. So if we make a parallel, very few people know about the LIBOR or the SOFR or other benchmark rates. Very few people know about interest rate derivatives. But if you've ever taken a car loan or a home loan, you've dealt with these. Why? Because that instrument is priced off a benchmark rate. There's some premium fixed, by the financial institution. They go out to the market to procure the capital, and then they hedge that rate with an interest rate derivative if you're taking a fixed rate loan, right? So anytime anyone has taken a fixed rate loan, it's dealt with a benchmark rate, it's dealt with an interest rate derivative, and you may not know it. Okay, so this benchmark rate is an extremely important concept in traditional finance, right? You need this market transparent rate, and actually, it's an alternative to the central bank rate. It's supposed to be the free market cost of capital. But the LIBOR, it was wound down because of one problem, and that is rate manipulation. And that rate manipulation was by the bankers inside the banks, because they were over or under reporting it by a single basis point. They were taking the opposite trade, and they were pocketing the profit. So you have this conflict of interest. You have this not just opacity, but you have actual manipulation inside the financial institutions that are supposed to keep this rate for the market.
That's the black box, right? I mean, that's the black box right there. Yeah.
So if we take this kind of black box that can be manipulated by individual bankers for their own profit, and we replace it with blockchain technology or the blockchain infrastructure, what do we have? So rather than having, bankers inside, right across Facebook Messenger to, to their bros and say, I'm going to take this side, I'm going to over report it, take the opposite side of the trade. We replace that with something transparent, which is a smart contract call. So on Aave Compound, for example, you get an interest rate that's set by the market activity. It's auditable, it's transparent, it's in the smart contract. It can't be changed by Aave or Compound. And the IPOR smart contract is calling to those smart contracts. Yeah. So you have all these smart contracts talking to one another that cannot be, the rate cannot be manipulated by the reporting side. And anything that happens is a market activity. So if you replace this dynamic, you can already see that it's a huge improvement over self-reporting, because inside the banks, it's trust me. Inside of IPOR, it's trust the smart contracts.
Yeah. And we know how that goes in light of what happened with Three Arrows and the rest of the boys paying off on the side and kind of like trying to delay their payments, but when it came to the blockchain, they couldn't do that, and that's what we want. Yeah.
All of that, all of that shows that the trust structure in centralized institutions was actually the root of the issue. FTX, correct. All of these blowups are centralized. And if you look at Celsius, the only way that we could see what was happening, or the only view that the world had to their internal books, was them paying off their Aave debt. So DeFi correct. Was the only transparency that you had into an opaque CeFi. And so this is a better construct. And the other part of the better construct, rather than publishing it, once a day, British Standard Time, it's published, it can be calculated up to block over block. That's why it's called the IPOR, the inter-protocol overblock rate. It's as close as you can get to real time in DeFi, rather than, in the LIBOR case, you have at 11 a.m. BST, Monday to Friday, no weekend rate, no holiday rate. So, the DeFi markets never sleep. So you get a better construct all around. And something like this narrative, if you understand it, I mean, how can you not say that this is a better approach?
I think this is the very core of what it is that, we, from like a blockchain functional enthusiast, scientist, engineer, I mean, all of that kind of stuff really does come to the fore of these kind of products. And I think that's why, from a Blockmate's perspective, this is why we love, like, essentially reporting and writing about projects that are actually coming in, taking an existing construct and completely putting it on its head and saying, let's do this and let's do it better. And most of the time, like, the really serious builders come in and do exactly that. And it sounds like that's exactly what it is that you guys have done, to the extent that, I mean, I have to ask this question. Isn't that even more reason for the incumbents in the traditional finance world to not want blockchain to succeed even more?
I would argue that a lot of the maybe the regulatory push is being pushed from inside financial institutions as protectionism. So this is there are a lot of arguments that are not around this, and a lot of it is the KYC AML component, right? And you see something like Aave Arc, which are the gated institutional pools, and it really didn't get any traction because the institutions actually you don't want institutional capital just there playing with each other, because it's like you have a Shark Tank with only sharks. Sharks need fish. But yeah, I mean, you really change a lot of the dynamic. So, for example, we were talking about scalability inside of crypto, inside of DeFi, right? Software scales. This is why we have Web 2.0. It scales a lot of things, right? You moving everything to cloud infrastructure. The cost, to build something, the cost structure doesn't scale linearly. It scales exponentially. So if you think in the blockchain perspective, if you can do these things such as contract settlement, you cut out a lot of middle and back office jobs. How much of the bank's job is actually reconciliation of trades, right? Actually shuffling Excel sheets by email to reconcile trades. And that, as a technological perspective, it puts a lot of people out of business because it makes this process, it replaces the process. So it really changes the dynamic.
Correct. I agree with you, by the way. I think that is very much at play, and there is the protectionism that is in place. I mean, it's obvious. It's just that's why wars are fought and won, and then you cling on to it, you know. And as far as they're concerned, they've won that war. They don't need to go and fight it again. I think the most interesting part about this whole thing is, like, how does little old retail investor like myself benefit from what it is that you guys have created and endeavor to take forward to, you know, the 1 month, the 2 month, the 3 month forecast?
Yeah, so maybe I'll paint a very broad picture here, right? So the IPOR as this kind of base of the DeFi credit markets. In traditional finance, it's actually the largest market that nobody knows about, right? It's a $450 trillion notional behemoth that underwrites global debt, right? This is the interest rate derivative market in traditional finance. And if we can replicate that in DeFi, you know, this will be the base of this DeFi credit market. So that's a little bit of the opportunity perspective. It's really, you know, its bounds are limited or open to the growth of the DeFi credit market. So if the DeFi credit markets take off, then IPOR can be this kind of base layer. And actually, maybe they go hand in hand. Maybe IPOR enables the growth of these DeFi credit markets, and that's actually, you know, what we argue. It provides this stability, predictability, which actually ends in liquidity. So once you have these stabilizing factors, you have this predictability of cost of capital, more capital will flow in. So about participation, actually, so interest rate derivatives are typically instruments that are only available between two financial institutions and over very large instruments, right? So if you're hedging, you know, like tens of millions of dollars in debt, then, you know, these are very interesting for, but it's only available, you know, from one financial institution to another. So the only exposure that retail gets to this is actually, you know, in the kind of fixed rate loan perspective, right? We adapted an interest rate swap, for example, from the tradfi perspective, and we took the best of DeFi. So that goes back to the last point that you were talking about. So we adapted this. We said, okay, so this is a really cool instrument. It's a very liquid instrument. It's one of the most traded in traditional finance. How do we put it into the DeFi perspective? So, okay, it's really difficult to bootstrap a two-sided market. So let's use some of the best of DeFi. One is the peer-to-pool mechanism. So on these interest rate swaps, one side is a trader and the other side is a liquidity pool. So it really depends on, you know, what part of the system that you are taking part of. Are you a trader? Are you a liquidity provider? The liquidity provider, they underwrite the swaps. The trader, they take the swaps because they, for example, want to hedge, they want to arbitrage the rates, they want to take a directional position. And at the middle of that, there's this kind of brain, right? It's the AMM. And because it's interest rates, it's not trading two different assets. You're actually trading the rates. And in rates, you're really looking at volatility. So it's a bespoke interest rate derivative AMM that was designed by IPOR Labs. And that's what's pricing the instruments. So we adapted this traditional instrument to DeFi, took the best of DeFi, took the, you know, kind of these quant toolkit and put it on chain. And built this instrument. So what does that mean? One, you know, this instrument is open to anyone who has, you know, an Ethereum wallet, so they can hedge their risk, right? So for example, if someone's taking out a loan from Aave, from Compound, they can take a pay fixed position to hedge the rate risk, right? The other thing is that can be done into a multi-contract call, so you can also create a very simple fixed rate instrument. The other side of it is the deposit side. So if you're a depositor, you're underwriting this risk. So this is a viable opportunity for yield. So if you have USDC, USDT, or DAI, you can deposit it into the pools, and you're looking to earn, right? And where does that income come from? Well, from the protocol side, you deposit it. That protocol is underwriting the derivatives. So it has kind of three incomes. One are the fees for opening the swaps. Two is the net outcome from the swaps. And three is money market yield or asset management. So while the assets are in there, but they're sitting idle, they actually go out to Aave, they go out to Compound to yield on this basic rate. They also get different aspects from they get protocol generated revenue.
Your next career move could be the one you never imagined. Web3 nomads, everywhere jobs for anywhere people.
So there's a lot of different ways to take part in this, and yeah, maybe I'll stop here.
So I think it's incredible because there is kind of like, if you had to take this thing, like what we love to do as a community and especially as blockmates, and what we love writing about is like, what are the different strategies that can be employed, with any protocol. And some of them are very straightforward. It's kind of like, the online DEX perpetuals, you open along, you do a short, you might be able to stake and do that kind of thing. But then there's like these kind of protocols where it's like, there's so many moving parts, there's so many levers that are actually in motion, that just trying to understand like just the hedging side of it. I mean, I'm going to be brutally honest, I don't understand it to the extent that it needs to be understood, so that I can go in and get the benefit of this whole experience, like from a financial perspective, whether it's hedging. I think it's remarkable that this is the kind of thing that ultimately we are replicating, that is going on in the TradFi world, but it's not happening kind of like a one side wins all. It very much is an open thing. Sure, people are going to be better at it than others. People are going to employ different strategies. And for me, the remarkable thing here is what strategies can be employed. I mean, I don't want to get into that with you because I think that's for another time. But what it is that it just shows you how robust and how deep this thing really does go. And the next question that I wanted to ask you is, like, just in simple terms, Darren, what are the different strategies like on the superficial level? So the one is hedging, right? What are I think there's three of them, like the three obvious ones. What are they?
Yeah, I mean, hedging, arbitrage, directional bets, right?
Okay.
These are the main things, right? So if we look at okay, so let's go back to TradFi. You're talking about 450 trillion notional. I think 2021 it was 600. It's multiple, it's multiples over the credit markets, right? I think the credit market's like 100 over around 100 trillion, right? So if you were to hedge everything, right, then your notional exposure would be 1-to-1. But obviously, there are other, mechanisms there are other strategies being deployed, right? So you can get cross-currency arbitrage. You can play the divergence or convergence of different rates between different, different currencies. You can play the divergence of rates between USDT, USDC, or DAI. You can take a directional bet, like if you think that so we've actually had an inversion of rates recently, between DeFi and TradFi, right? The TradFi rates, from 2020, they've gone from 0 to 5%. In DeFi, from 20 to 10%, now down to 2-3,
Yes.
right? So you can take the directional bets. You can try to arbitrage this TradFi and DeFi world. You can play the convergence or divergence if you think that USDC and USDT are going to diverge because you have regulatory pressure on one or not the other, or you think they're going to converge. You can take offsetting swaps. There's a lot of different interesting strategies, and these will be much more interesting as the market develops, because they're now limited because we're only looking at like kind of 1 month swaps, at least in the IPOR protocol terms.
Yes.
But as these rates go further out, you'll have like this inversions of rates, where you have different pricing at different tenors, and there's different ways to trade those. So our head of business development just wrote a piece. I think the next one's coming out today, it's a 3-part piece called a relative value thesis for DeFi, and this covers all of the different, all of the major interest rate trades that you can take, once a market is mature. And so you can consider this like kind of a blueprint of, one kind of the product roadmap inside of the IPOR protocol, and then what are the different trading strategies that someone can employ, as this term structure gets developed.
So I need to go and play now. I mean, it very much is that, it's kind of like, okay, well, how do I play? And it's, I mean, obviously, you guys launched, when did you guys launch? It was,
so mainnet, I think, was August 16th.
It was August, yeah. So there was quite a bit of coverage before, but it was kind of like you're a bit of a dark horse, and then you did Arbitrum. That was recently, right?
No, we don't. We're not on Arbitrum. We're actually on Ethereum mainnet only.
Only, okay. So why are you guys not on Arbitrum?
So the short reason is it's your derivative market underpins the spot market, right? So the most liquid credit markets are on Ethereum.
On mainnet, yeah. Okay.
The other thing is, so from a volume weighting perspective, the only kind of influential markets now, if you're talking about volume weighting, are Aave and Compound, V2s on Ethereum. But this is something dynamic. IPOR is not Ethereum project. It's a DeFi protocol, right? It's agnostic, and it will develop as the DeFi credit markets develop. And the most important thing about this is actually it's DAO governed, right? So the DAO actually infrastructure is being put. It's in development. It's the main thing for this year. And we already have some cool things that will be piloted, which will be a forum inside of Discord that's native to governance. So you can actually take your kind of Discord profile, your Crew 3 profile, which is the community building the community building tool that we're using, get a certified DAO badge, and then go inside and be on the decentralized governance. And so, for example, some of the governance factors will be, okay, so what protocols are on the rise? What should be actually included in the IPOR Index? Because protocols become a proxy for financial institutions. How should the weighting change? Should the IPOR be deployed on other chains? The other part of that answer is that this infrastructure is fairly complex. So, for example, the asset manager, it goes out to Aave and goes out to Compound, right? This is where the capital is being deployed, because those are seen to be low risk because of longevity, because of security audits, because of they have a very strong market position because they have been robust, at least so far, against cyber attacks.
Yeah.
And then so that infrastructure is not easily replicable to Arbitrum. For example, I think there's only Aave on Arbitrum, so the asset manager would have to be changed. It also cuts the utility a bit, but and the other part is that typically interest rate derivatives are much larger in size, right? So they've been taken by someone that may have a $10 million position, right? And they're looking to hedge it, with an interest rate derivative, and they're not as sensitive to an Ethereum mainnet gas fee. But this infrastructure can be deployed on other chains. I'm sure that the IPOR will take in data from other credit markets across other chains, and it will. I mean, the whole point is that it evolves. So maybe one of the interesting things is to check the IPOR manifesto, which is talking about this kind of adaptability that goes with the DeFi credit markets.
I mean, obviously, a lot of the communication that you guys, come out with is that there's this, the emphasis laid on building a public good. You've obviously touched on, the DAO, and obviously the importance, and it seems to be the longer that you're in crypto, the more you understand the value of kind of like the decentralized concept, and more importantly, the application thereof, where it's not just about one person. The fact that you're a CEO is actually kind of irrelevant in light of the fact that you want to be in a place where it's not about you, it's not about your co-founder, it's actually about the collective. Now, what is this public good all about in terms of the way that you guys are perceiving it? Can you just elaborate on that?
Yeah. So again, going back to the LIBOR perspective, it's a benchmark rate. It's just a number or a series of numbers. It was called the world's most important number, and that's why it was also, that's why people were taking advantage of it to manipulate it. But if we have this kind of better construct that's on chain, it's actually printed to Ethereum via an oracle, right? And so that's a public good, right? So this cost of capital is printed every so often on chain, and actually the more protocols that use it, the more often it will probably be printed, because they can also help subsidize the printing on chain, right? That process right now is only subsidized by the IPOR interest rate derivatives. But what does this look like? So again, it's just a number, but that number can be called by anyone. So let's imagine you're trying to spin up a credit market. You have this kind of demand utilization component. Maybe you use the Aave or compound, bonding curve, the utilization rate with this hockey stick spike to bootstrap your credit markets. Okay, great. But maybe you don't need to. Maybe actually you just point to this interest rate benchmark, and that's the basis for your rate, right? It becomes a much easier construct, and maybe it's much more useful for bootstrapping, other instruments. The other thing is you can use this, let's say like a decentralized bank that's taking a money market position, taking an interest rate derivative, an IPOR interest rate derivative, and they're offering this fixed rate. Well, they can offer this. They can quote the on-chain IPOR index. They can procure the capital from the market. They can hedge the risk, and then they can underwrite that risk by providing a fixed rate borrow. You can have, let's say you want an NFT lending market. You can call the USDT rate and add 2%, right? Yeah. I mean, things like this. So the whole, like if we imagine in the traditional world, it's kind of difficult to think about, how things are pegged to one another, how rates are pegged to one another. In the DeFi world, or in blockchain, or in computer science in general, you can do this like kind of cluster analysis. You can do intercorrelation between different protocols and smart contracts, right? So the future value of the IPOR index, and actually the IPOR index, in my view, is the most interesting thing. It's actually not the interest rate derivatives. It's the IPOR index in general, because this is the public good that can be used to peg everything to this index. It's the barometer. It doesn't set the temperature. It doesn't, or the thermometer. It doesn't set the the temperature, or it doesn't read. It doesn't set the state of the room. It reads it. It is the rate, because it is the rate, because it's actually referencing the credit market activity. So going back to this cluster analysis, the value of the IPOR index will be what's the quantity of instruments that are referencing the IPOR. For example, what's the quantity of external protocols that are referencing the IPOR protocol? What is the quantity in terms of value that's pegged to this IPOR index that's being printed on chain? What is the velocity that this index is being referenced? So this, I think, from a visualization perspective, is quite interesting. Again, the quantity, quality, and velocity of smart contract calls to the index, that will be its value.
Fascinating. Great. I mean, it is almost like the constant, because it's not beholden on anything or anyone. Well, it is beholden on what is happening on the blockchain, like you say, the communication between contract to contract, and at the end of the day, the code is king. It's kind of like what it's about. It's not about individuals. I really like that. When it kind of like the big things, liquidity, so when it comes to liquidity provisioning, IPOR is, it's obviously able to attract, the yields for the stable coins and for liquidity providers to obviously come and participate in this thing. Can you briefly touch on like, I think it's more so the risk factors that could be associated with that process. If there are any, firstly, and if there are, what measures have been taken from kind of like IPOR as a protocol to mitigate those risks?
Yeah, sure. So first, if you go to the app, you can see on the liquidity mining screen, there's this kind of it looks like a flow chart of different things, right? So if we walk through that, there's this base yield that you can get as a stablecoin depositor, and this is stablecoin on stablecoin yield. So again, where that comes from is the asset management. So going out to Aave, going out to Compound to yield, the fees for opening a swap, and the net outcome of the swaps, right? So that yield is there; it's not going away. So there's no impermanent loss. The loss and the risk is if the pool, for example, is not profitable in underwriting the swaps, if it essentially loses to the traders. This can happen. And actually, there was a big rate manipulation, and this is not rate manipulation like someone said, okay, I want the rate to be this. It was actually a market activity. So we consider it it is a market activity. So there was an Ethereum address that was flushing the rate up on USDT, and they'd taken a long, on the IPOR USDT derivatives, right? And they kept that at a sustained rate, and they were trying to basically, print money on the longs. The other part of that is, it hurts the shorts. Obviously, it hurts all of the participants in credit markets, but that's the dynamic. That's the way that this market works. But so that ended up in about a 0.5% loss to the IPOR USDT pool. That's 0.5%. So it was about 50K on around 13 million in deposits. Right, so that risk was mitigated. Found the attacker. We had to step in and actually close the swaps. There's still this growth. It's basically a training wheels phase, not only for the instruments but for the protocol as a whole. And this, think of it from a responsibility perspective, right? The job is to protect, first the depositors, then build in the essentially the risk mitigation, and take the training wheels off, right? And that's really the phase we are, and then progressive stepping all the way towards DAO governance. So, for example, one of the things that's come out of that is we have 2 different risk modules that are under study right now, and this is how to calculate max drawdown, what's the max risk the pool can underwrite, how to punish in a severe way taking the pool out of balance. So, for example, to expose the long or short, and this would be something like slippage on the rates, also capping leverage dynamically, right? So this is something that's in process, and this is some of the risk mitigation actually on the IPOR interest rate derivative side. So the other part of the yield for the depositor, so I think since inception it's about 5 to 7% stablecoin and stablecoin yield for USDC, USDT, and DAI.
That's very good. I mean, in terms of the amount of TVL that you guys have at the moment, what is that number? Because it's nowhere near like what I would have expected it.
It's just over 40 million, or over 40 million, and it's getting some of the highest yields, stablecoin on stablecoin, single-sided exposure, no impermanent loss possible, and it's all coming from economic activities. Crazily, it's coming from people paying for something, right?
Yeah. It's amazing, because I think that's kind of like, and especially, I mean, obviously we've had like a really good upturn, over the last month in terms of what the market's been doing. But I mean, obviously during the bear market, builders are going to build, and what I find really fascinating about this whole thing is that you guys, obviously you launched in August, was probably like in the depths of this bear market. What do you think happens in terms of what it is that you guys are doing? And it's kind of like ties into the question of like, where do you guys see yourselves, or rather, what is your wish list for the next 3 to 5 years? Like, where would you like to see IPOR in terms of I mean, I know crypto is like, the dog years thing and that, but I mean, I think it's an interesting question to try and answer.
Yeah, so 3 to 5 years, I mean, it's really the extension of a little bit of everything, right? So one, we need to start getting this kind of bootstrapping of a yield curve. That's getting these, forwards rates, also rates markets, right? Interest rate forwards, interest rate futures, liquid fixed income, instruments, 6-month deposits, 1-year deposits, right? And that will start to be able to create these future rates to have this kind of yield curve formation. And really the goal in that is to extend 1 month at a time. We have a spot rate. We can use a spot rate to get to 1 month, 1 month to get to 2, right? That also goes hand in hand with the extension of the duration of the instruments, right? So we go from a 1-month swap to a 3-month swap, 6-month swap to 1 year. And we can't really work any other way. And this was purposeful. We were looking at some of the others, the different fixed income plays, the rates markets, the coupon markets like Pindle, Element, Notional, and saying, okay, it's really useful, but to underwrite these like 1 year and 6-month instruments, you just have finger in the air. So we really need to start, now building out into the future. So this was one of the reasons why we started with the spot index and are looking at the extension. 3 to 5 years in the future, we want to be able to say that, these on-chain rates and these on-chain interest rate derivatives are being used into smart contract calls, into multi-calls that are being able to facilitate, these fixed rate borrows, these fixed income instruments, so that there's this invisible infrastructure. Sorry, I'm a bit dying with a cold.
No problem, Darren.
So.
No problem. I think I'd like to wrap it up now, but I think what really does speak to this creation that you guys have come is that there are numerous strategies around what it is that you can do. There's obviously, from a cross-chain perspective. Last question. I have to ask this question. Was there a consideration around something like layer 0 in terms of provision, like accessing what was happening on other chains? Is there a benefit to that? Is there a benefit to kind of like extending what it is that you're doing on mainnet and reach out to liquidity and to other markets on other chains, or is that not a consideration?
One, absolutely. Two, the IPOR protocol is conservative in the fact that it's trying to source the, let's say, the risk-free rate, right? So for example, more experimental rates are currently not included in the index. It's more trying to, apples to apples.
Yes.
So the over collateralized markets are the most secure, right? So consider the lowest risk. And one thing you can look at the IPOR rate, you can say, okay, so I'm returning, multiples over the IPOR rate, but you can consider this as like a risk adjusted yield and know that you're assuming some sort of risk over the over what's the risk-free rate of the IPOR.
Gotcha.
The other is the construction of the asset management, going to Aave v2 and Compound v2 on Ethereum, right?
Yeah.
Once you start crossing bridges to get marginal gains on the rate of return for stables, you open up the protocol to potentially 100% loss for marginal gains. So I think it will, but this will be a governance decision, but from an engineering perspective, it maybe makes sense more to deploy natively than bridges. Me, I'm scared to death of bridges. They're extremely useful, they're necessary, but at this point, it feels like too much of a risk for the potential marginal gain.
Gotcha. Great. Thanks. I mean, I just couldn't stop wondering about it when there was like this, okay, well, we're on mainnet, how do you access the rest of it? It's clearly, it's not an important thing at this point in time. Maybe when we're in a state where we do have those trillions of dollars accessing across multiple chains, then, I would imagine that would be a consideration. But
well, it definitely is. It definitely is. So, the IPOR is, again, it's chain agnostic. Right.
Yeah.
So, for example, from the start when we started looking at this, Aave and Compound were the top from a volume weighting perspective, but over DeFi summer in like 2021, Avalanche ecosystem got up, and and so we're looking at these rates and the credit market and seeing what kind of impact they would have on the IPOR index if they were included in the index. The other question is, how do you deal with essentially cross-chain messaging or reporting of rates? How do you take this IPOR infrastructure? So right now, the rate is calculated on chain on Ethereum, but for example, when you start getting rate data, smart contract to smart contract from another chain, how do you source that? How do you make sure that the index aligns with different block tempos? How do you deal with different reorgs? These are engineering questions, right? But certainly they're definitely they're worth dealing with. And for example, of course, right now everyone's talking about Arbitrum. It's getting I think it just flipped Ethereum in terms of transaction volume just yesterday. But still, the DeFi credit markets there are tiny, right? But it could be an interesting place to deploy the swap infrastructure, just trading the mainnet rates. So all of these things are on the table, but it's not a rush to deploy the infrastructure, because as an infrastructure piece, it should be conservative by nature.
100%. Great. That's a great summary. Thanks, Darren. I actually understood most of what it is that you brought to the interview today. I think there's a lot there that still needs to be unpacked. I mean, we're working on an article at the moment, so we should have that out next week, which I hope breaks it all down in a very straightforward and way that Blockmates likes to present information like this. I am very keen to look at the various strategies that are potentially, or that can be potentially kind of like put into motion with what it is that you guys have built. I think it's great to see how we've had this remarkable shift from all these Ponzi's and all these like crazy things from the last cycle to stuff that's meaningful, some stuff that's super sustainable and actually really adds value to what it is that we're doing. And sir, thank you for that. I mean, I think that's a great accomplishment. Well
maybe before we close, like, we could talk about really quick the last thing about the DeFi primitives are the power tokens, right? So you mentioned like the Ponzi's and Ponzi-nomics, right?
Yes.
Power token is a DeFi primitive that was created inside of IPOR Labs. It was done by my co-founder Dimitar, and it's actually a response to the anti-Ponzi-nomics. It's looking at something like curve or convex. It's looking at like these time-weighted elements. So, for example, one, it's an architecture, right? So, for example, the staked token, in the case of IPOR, is Power IPOR. It can be delegated to a number of different modules, and each of those modules can accomplish something different. So that's an architecture kind of innovation. One of those modules can be governance. One of those modules can be liquidity mining. Maybe one of them is actually like delegation of liquidity mining. The other part on the liquidity mining and how IPOR really jumped up in the TVL, it almost had a 20x increase in between mid-January and early February, was that it's a fair market dynamic, right? So this was one thing that's really important, inside, and it's one of the things that Dimitar and I really aligned with, talking over. We've known each other now for about 5 years. So this power token liquidity mining, it's not weighted towards whales. It's not weighted towards early depositors. It's a fair market dynamic, right? So for example, it's a relationship between the liquidity that you provide and the IPOR that you stake. And it's ratio based. So it doesn't matter when you come in. It doesn't matter whether you're a whale or whether you're a minnow. You can always find this ratio between the liquidity that you provide and the liquidity that you stake, and the Power IPOR token that you stake, which means it's attainable, and it's actually meant to capture a lot of the middle. So there's something called Diamond Hands bonus, which was just launched on the site today, which is showing like if someone is a mercenary farmer and they choose, so there's a 2-week cooldown currently. So if you are a mercenary farmer, you can take a 50% unstaking fee right away and go sell it. But that 50% is being distributed towards those
By the stakers.
diamond hand bonus. And this is a way to move from, for example, mercenary farmers to those who have long-term incentives. So that's paid in Power IPOR, and it can be immediately redelegated. So the people that are inside, they can always play with this kind of boost mechanism to find their most effective boost. So this fair market dynamic is also really important for longevity of the protocol. So we're trying to innovate across kind of all the spectrum, you know, from DeFi primitives to public goods to you know, to things like the power token dynamics.
I think there needs to be another interview. I think we need to get you back. I want to talk about strategies. I want to talk about, I'd love to reflect upon how the diamond hands, I mean, that's another strategy as well, how that plays out. And it will be really interesting to see what the data reveals in terms of like stakers versus mercenary. How long did it take for the mercenary to stop coming in, you know, because of that? So it'll be really interesting to reflect upon that. Thank you, Darren. I really appreciate your time, and I know that you're not well. Take some rest. I know that you're away next week for a conference.
I've been not well for a while, but I'd say the last 12 years.
But thank you very much. Really appreciate it. And to all our listeners, please like and subscribe. And what I'll do is I'll leave a link to the article that we're going to be publishing. And we'll also be putting a thread out on the article, and we'll have this video out next week. So really appreciate your time, Darren. It's been an absolute pleasure, and good job on what you guys have created. It's beyond impressive.